I think our slides will begin soon.
Can you see my screen?
Yes, but not in presentation. Well, not anymore.
Let's try.
I know. Thanks everybody for joining. We just have a quick. There it is.
So, this is like Dinero. They're not 100% sure, but
Are they talking?
yeah, they're showing this video.
Hello, everybody. Buenas tardes. Hello. My name is Patricia Perez, and I'm AARP California's State President Emeritus. It is my pleasure to welcome you to Let's Talk Dinero, our plática, our monthly charla. Today, we're focusing on financial strategies and taxes. No matter your age, planning your financial future starts today. It may sound complicated, but trust me, we're here to help. We know that there are competing responsibilities that affect your financial decisions, but having a strong financial plan will help you and your familia be better prepared for the future. And we have a pro today to help us. But first, let me tell you a little bit about Luis Rosa. Luis is the founder of Build a Better Financial Future, LLC, a financial investment and advisory agency. He's from the Dominican Republic and came to the US at age 11, and like many children of immigrants, was inspired by his parents to work hard and pursue an education. He's bi-coastal, growing up in New York and now living in California. And he noticed the lack of financial literacy in his community and now utilizes his expertise and online presence to help increase financial knowledge and motivate young professionals to join the financial planning industry. He's the host of On My Way to Health podcast and co-founder of the Latinx internship program. Luis has received numerous accolades for his work as a financial advisor, including being named one of Investment News 40 Under 40, Financial Advisor Magazine's 10 Young Advisors to Watch, as well as Investopedia's top 100 financial advisors. He's also been recognized as one of the 8 Hispanic personal finance influencers to follow for money advice by the Penny Hoarder and Nerd Wallet. Those are some serious credentials. Pretty cool, Luis. But before I turn over the program over to you, Luis, I'd like you to get to know our audience a little bit better. So I'd like to take a quick poll, please. All right. I just have a questions for everyone. And the question is, I have filed my taxes for 2002. I'm sorry, for 22. Have you already filed your taxes? Just yes or no, everybody. Have you filed your taxes? All right. Is everybody submitting? Some people are, some people aren't. Let's see, can we view? Let's see, can we view the results? There we go. All right. So, the majority already have. 64% already filed, but a number of us have not done so yet. So thank you all. So Luis, this is a pretty, diverse audience here. So I think we can benefit from your expertise. And, also reminder to everybody that you're welcome to submit your questions by writing them on the chat box, or if you're watching on Facebook, entering them in the comments. But anyway, enough witty. I want to turn over the program over to Luis. Bienvenido, Luis.
Muchas gracias, Patricia. Welcome, everyone. Bienvenidos. It's a pleasure being here. And thank you all for answering the poll question. Much appreciated. It's okay if you live in California and you have not filed your taxes. There might be some good news for you if you've been impacted by the storm. So we'll talk about that. So let's talk dinero, right? Tax season is always in season. I'm going to share my screen now so that you can see some slides. Let me know. Give me a thumbs up if you can see it. All right. Thank you very much. Quick disclaimer, as you've seen before, this is for information and education purposes only. So please consult with your financial planner, your tax advisor, or your attorney before you implement any of the information that you learn here today. So what is the difference between tax preparation and tax planning? Well, tax preparation is very backward looking. It basically takes a look at what have you done in the prior year, and then compiling that data to create a tax return that you're going to file with the federal and the state government. There's not very much you can do at that time in order to plan for anything. There are some exceptions, like you could still contribute to an individual retirement account, or if you are self-employed, you might be able to still contribute your employer contribution to your 401k, your SEP IRA. But aside from those, there's really not a whole lot of planning that you can do. So the best time to see your CPA or tax professional is actually not during tax time, believe it or not, because it's always tax season. So you actually want to look at tax planning as a tool for you to plan for the future. This way, you can look at strategies that you can implement during the year to have a better tax outcome in the future. So you can meet with your CPA or your financial planner, or maybe even both if you have them, to kind of look at where you are today and what are some of the things that you can do, particularly lowering your taxable income. And we're going to go into some of the strategies that you can use throughout the year to do that. So I'm sure you'll be happy to learn some of those, because who loves paying taxes, right? Probably nobody. So there are some legal ways for you to actually be able to lower your taxable income and have a better tax outcome. So let's look at some general tax season tips so that, tax season is fresh in our memories. One of the things that the IRS recommends is that you file electronically. Most people do nowadays. There are some people that still mail in their returns. It's more optimized. You're going to get a better turnaround time if you file your returns electronically, specifically if you are getting a refund, because if you combine filing electronically plus requesting direct deposit to your bank account, it's going to be processed sooner. And you're also going to get your refund in a safer manner, because if you file your returns and you do not request a direct deposit of your refund, you're likely to have that check get lost in the mail. It's going to take longer, or it can fall into the wrong hands. I've seen that happen before, where somebody's check gets cashed by someone else, and then it's just a big hurdle that you have to go through to try to get your money, right? So ideally, you want to file electronically. and request direct deposit. This is another opportunity here that you can do now that tax season is over to prepare for next year. It's actually to obtain an identity protection PIN from the IRS. What you can do is you go to irs.gov and you're able to obtain a PIN that is unique to you, and it varies every year. The reason for doing this is because you might have heard a lot of big companies that get hacked. This seems to be a very common thing where even if you're doing everything to protect your information, it is possible that your healthcare provider can get hacked, your employer, and so on. And those hackers might get access to personal information of yours, and that may be enough for them to file a fraudulent tax return. So it could be your social security number, your date of birth, your address. They might have enough information to create a fake return, file it ahead of you, and then when you go file your return, the IRS rejects your return and says, you already filed the return and we already gave you a refund. So that has become a very huge and common problem, unfortunately. So one of the things that you can use to be proactive is go to the IRS website and request an identity protection PIN. That way, every year you get an IRS letter, and this is the good kind of letter because it doesn't mean you owe money. It's just giving you a PIN for that specific year. And if anybody tries to file a return and do not have that PIN, they're not going to be successful. So this is going to save you a lot of headache potentially. So I highly encourage you, even if you have not been a victim of identity theft, you can go ahead and request a PIN. So highly recommend that you do that. Another quick tip is for you to gather both documents, both in the mail and sent electronically. A lot of us are doing a lot of online activity, paying bills and so on. And very often we sign up for e-delivery of documents because we don't want statements being mailed every single month and so on. But we tend to forget at tax time that we may actually have tax forms that will be delivered electronically, either a notification to our inbox that says, hey, your tax documents are ready. So I've seen a lot of people make this mistake where they only take the documents that come in the mail and forget about the fact that they might have had, for example, like bank interest, and they forgot their 1099 INT and forgot to report that income under taxes, which then results in an IRS letter later, or perhaps having to amend the return, depending on what type of document it was. So one tip is for you to create a digital folder inside your email inbox. And every time that you get something that says it's tax related, just move it to that folder. You could even get fancy and create filters so that everything that has the word taxes goes right into that folder. So that's going to be a great tip for you, just to be better organized and to make sure that you don't miss anything. Here's another one. You might hear that you want to file soon, but at the same time, depending on your situation, you might not want to file too soon. For example, if you have investments in a brokerage account, most of the time, you're not going to get the tax forms if you had any transactions throughout the year, some buys and sells, until later on in the year, sometime maybe mid-February. So if you go ahead and file immediately when tax season is here because you got your W-2 and you think you're ready, you might not report everything that you were supposed to on that tax return, which might result in having to amend your tax return later. So if you fall in that category where you have investments and you did transactions throughout the year, make sure that you speak to your financial advisor or log into your account and see when that 1099-B is expected. That way, you know, okay, it's mid-February, so I'm just going to gather all my documents, but I can't file just yet. So another great tip there. So when we were talking about some of the tax planning that you can do during tax season, you have until the tax filing deadline of the current year to contribute to a retirement account like an IRA or a Roth IRA for the prior year. So for example, this year you had until April 18th to contribute to an IRA for tax year 2022. So this is one of the things that you could in fact do at the very last minute. And when you're doing your taxes, you can decide if it makes sense for you to do. And as long as you do it before the tax deadline, then you can go ahead and do that. Know your deadline, speaking of which. So most of the time it's April 15th for most people. Sometimes it varies, like this year was April 18th. So sometimes you get a few days extra, depending if it falls on a weekend or a holiday. Also, if you are self-employed, your deadline may not be April 15th. It may actually be March 15th. So if you have your own business, speak to your accountant, because if you think you're going to do your return, say April 1st, you might have already missed the boat on the business side of your return. So you want to make sure that you are aware of your deadlines, whether it's filing for your own taxes and also providing the IRS or the state of California estimated tax payments throughout the year, because there are specific deadlines that you have for those as well. So let's talk about tax brackets. This is a very important thing for people to understand when it comes to planning ahead. Not all of your money is taxed at the same rate. So when you look at this visual on the left, for example, the first column is for single filers. If you look at the first row, any dollar amount that you make from $0 to $11,000 as a single individual is going to get taxed at the 10% rate. As that person makes more money, let's say they made $30,000, the first 11,000 gets taxed at 10, and then the remainder gets taxed at 12%. So the more money you make, the more money that gets taxed in the next bracket, all the way up to 37%. So they go from 10 to 37 currently. For married filing jointly, the same concept, but the numbers double for most of the brackets, as you see. Instead of 11,000, it's 22. Now, why is this important for you to know? The reason for that is because you can implement certain strategies throughout the year, simple things like contributing to a 401k or an IRA that could actually help you lower your tax bracket where you would save money. Because if you are in the 22% tax bracket and you put $10,000 in your 401k, you just saved $2,200 in federal income taxes because that $10,000 does not get taxed. You actually contributed on a pre-tax basis. And that's not even considering the fact that you're also saving income taxes on the state side as well. So it's a huge savings to you, and you get to invest your money for your retirement on a pre-tax basis. On the right side, we have capital gains taxes. Capital gains are for things like investments, like stocks, or if you had a rental property that you sold, anything like that, it gets taxed completely different than your ordinary income tax rates, depending on how long you held it. So if you have it for less than a year, it's going to be taxed at the same rate of whatever bracket you are on the income tax side. So let's say you bought a stock in February and then you sold it in April. If you have a gain, that's going to get taxed as ordinary income. So it's important for you to know this too, because if you have a stock purchase or an investment property that you sold, and it might make sense for you to wait until you've had it for over a year to pay the lower capital gains tax, because depending on your income, that could be 0%. That could even be 15%. A lot of the times you hear in the news that these billionaires pay less taxes than their secretary. There was one that I saw recently. And what they mean is not the dollar amount, is the percentage. Because let's say that billionaire secretary was making, $100,000. He or she might have fallen into like the 24% tax bracket. But if that same billionaire just sells investments, they might only be paying 20% on their capital gains. And you can take advantage of the same rules, right? Just by knowing what they are. And that's why it's so important to plan ahead, because you can take a lot of your income that normally would have been subject to a specific capital gains, like 15, you might be able to switch some of those into the lower bracket, like doing things again, like contributing to your 401ks. So very important that you understand how your income gets taxed and also how capital gains taxes work so that you can take advantage of any opportunities that you can implement yourself throughout the year. So how can I lower my taxable income? This is everybody wants to know this, right? So before I tell you how some of the ways you can do that, I want you to know the difference between standard deduction and an itemized deduction. The standard deduction is what everybody has access to, whether or not they itemize the deductions. And I'm going to tell you what itemized deductions are. So let's say you have 0 things to deduct. The government says, look, you can take up to a certain amount and reduce your income by that much. No questions asked. So if you're single, you can take $13,850 off of your income. So let's say, to keep the math simple, that you made $53,850 for the year. The $13,850 will be your standard deduction, and your taxable income would only be $40,000, which is great. For married couples filing jointly, it's $27,700 for 2023, and for head of households, $20,800. Now, itemized deductions are anything that you can write off, and it makes sense for you to do if it exceeds any of these numbers. So some of the common itemized deductions are things like mortgage interest, if you own a primary residence that you purchased, or if you had a home equity line of credit that was used to either purchase or improve that property, you can deduct the interest on that. If you have medical expenses that exceed 7.5% of your adjusted gross income, those are considered itemized deductions. If you donated to charity, those are itemized deductions. So if you collect all of these things, any taxes that you paid, state or local taxes, like property taxes if you own a home. There are some limits, but ultimately, if you combine all of those and they exceed the standard deduction amount, you can actually take the bigger number, which is more beneficial to you. So something else to keep in mind, because some years you might be able, this is another tax planning strategy where you can look at certain things that you're doing throughout the year. I've heard of people even waiting or timing the time of their surgeries if it's something that's not urgent, just so that they have the deductions for the year. You know, so these are the kinds of things that you can kind of look at, or the timing of paying your property taxes or things like that, right? So let's talk about some of the things you can do. So 401k contributions is one of the very first things that's the easiest thing for you. If you are a W-2 employee or self-employed, you can have a 401k where you can contribute on a pre-tax basis. So if somebody makes $60,000 a year and they contribute $10,000 to their 401k, their taxable income is only $50,000 because you're contributing pre-tax, which is a great opportunity off the bat. So that one, it's not even that hard, right? Just a matter of if you're able to contribute to it, and then you're lowering your taxable income automatically. IRA contributions. So if you either have a 401k or you don't have a 401k, you're still able to contribute to an IRA depending on your income. And I'll show you some of those guidelines in a bit. That also gets done on a pre-tax basis. So even if you do it with after-tax dollars, when you file your tax return, there is a spot on your tax return where you can let the IRS know that you contributed to an IRA, and that lowers your taxable income on that tax return. So this is another great tool. If you are self-employed, you can use a SEP IRA or solo 401k. So sometimes a lot of us have either we're self-employed or we're freelancers, or we get a 1099. There's people that may drive a ride share or food delivery or have any type of side hustle. You get a 1099, you are considered self-employed for IRS purposes. And then you can open up your own IRA that you can contribute some of the profits from that business to help you lower your taxable income. So that could be another great tool. Wanted to also mention some of the employee benefits that you can have access to via your job. So for those of you that have a high deductible insurance plan, you would qualify for a health savings account. Health savings account are a great tool for you to save money on a pre-tax basis and then use that money later on for qualified medical expenses. You can even invest it within the account if you don't need it. So you don't need to use it all during the year. I'm going to show you some of the limits and the way they work in a little bit. And you can take advantage of any other employer provided benefit, like flexible spending accounts or dependent care account to pay for childcare and things like that, or even transportation, adoption, or even education types of things that you can do via your employer. So whenever you have a new job or even a current one, when open enrollment comes in, make sure you look beyond just like the health insurance and the 401k, because there might be some pre-tax benefits for things that you're already paying for after tax that you might be able to pay for pre-tax, and that's going to save you some money. Okay, so here is how the IRAs work. You have a contribution limit every year, typically goes up. So in 2022, it was $6,000 for those under the age of 50. That's both for a Roth IRA or a traditional IRA. And that went up to $6,500 for 2023. And for those that are age 50 or older, they have a catch-up contribution of an additional $1,000. So if you're over, you're 50 or above, you can contribute up to $7,500 into an IRA. Now, whether or not that contribution is deductible, if you do it on a traditional, is going to depend on your income and your filing status. Roth IRAs have a much higher income threshold. They're not tax advantage today. So I'm going to show you some of those differences in a bit. But it might make sense for some people to take advantage of a Roth IRA instead, just because depending on where they are today with their taxes and where they expect to be in the future. 401k contributions limits are a lot higher. Currently, you can do the standard contribution up to $22,500 to your 401k and an additional $7,500 catch-up contribution if you're over the age of 50 or above. So you can contribute a lot of money through your 401k and lower your taxable income today as a result. There is a Roth option that some employers offer. So let's talk about those so that we know the difference between the two. So what is the difference between the Roth and a traditional? They're basically two sides of the same coin. And what you have to decide is, do I want to pay taxes today on the seed or do I want to pay taxes on the harvest? So here's what I mean by that. When you put money into your 401k or your traditional IRA, you're going to be contributing money on a pre-tax basis. So when you look at your tax bracket or your expected income for the year and you say, okay, I'm going to be in the 24% tax bracket, but when I retire, I expect to be in the 12% tax bracket, right? In that case, you would want to most likely put your money pre-tax because you're going to save the most by contributing at the higher bracket, right? Saving that money pre-tax so that you don't pay taxes on it. And then when you take it out later in retirement at a lower bracket, you pay less income taxes. Now, if the flip coin, let's say you are maybe looking to make more money in the future and you're going to creep up in those brackets. So you happen to be in the 12% bracket or the 22 and you're going to go into the 24 or higher later, you might want to consider contributing to a Roth IRA or a Roth 401k if that's an option with your employer, because you would basically lock in the taxation because you contribute after tax dollars. So you don't get any benefit today on your tax return because you're contributing after you've already gotten paid and that money was taxed. The benefit of that, though, is that then that money gets to grow tax-free if you follow certain rules. If you keep the account until age 59 and a half and take the money out after 5 years of having established the account, all of that money will be tax-free. So that's a great tool for you to think of when it comes to tax planning. And you can choose whether you can do pre-tax or after-tax, depending on where you are today and where you think you're going to be tomorrow. So that's another great thing that you want to do during the year. So that's basically, in a nutshell, the difference between Roth and traditional. So here are some of the income limits. I'll take one as an example because there's so many variations of it. But let's say a person that files a single return for 2023, they make less than $138,000, you can contribute the full amount to a Roth IRA. If you're a couple married filing jointly, it's between $218,000 and $228,000. You get a reduced amount. Less than $218,000, you can do the full annual contribution. Now, there is a way where if you exceed these limits that you can contribute to a Roth IRA still. It's called a backdoor Roth. It takes a little bit more to work around it, but there's also a way. So this is a great opportunity for you to speak to your financial advisor as well. If you happen to be on the higher end of the income and you still want to contribute to an IRA on the Roth side, you might be able to do a Roth conversion and do the backdoor Roth as well. And these are the traditional IRA deduction income limits. So depending on your income, your contribution may or may not be deductible. So you also want to know this because you don't want to contribute to a traditional IRA thinking that you're going to get a tax deduction and then at tax time find out that you made too much and the contribution is not deductible. You want to do that as a conscious decision. So for example, a single person making less than $73,000 can get the full deduction for their contribution, and then it phases out after that to the point where you may not have any deduction, right? So this is one of the examples where if you make too much, you might do the Roth IRA contribution instead, and if you make too much to contribute to the Roth, it might be a good option to do the backdoor Roth IRA as well. So here is the health savings account. I just wanted to give you the limits real quick. For 2023 is $3,850. So this is if you qualify for a high deductible health insurance plan with your employer, you can open up a health savings account. And in addition to contributing to your 401k, you can also contribute to your HSA. So it's another great way for you to save money on a pre-tax basis. Health savings accounts are triple tax advantage. So you can contribute pre-tax, let the money grow tax-free, and then take it out later for qualified medical expenses and not pay any taxes. So this is a very unique opportunity for those that qualify for a high deductible plan. And if you're a family, then the coverage is $7,750 with an additional $1,000 for a catch-up contribution. All right, and these are some of the other benefits that I was mentioning, is some of the most common ones. Flexible spending accounts. These are a little similar to the HSA, but not really. A lot of people get them confused. The reason is because they're also used for health expenses, but it's not really like you can invest the money and you can't keep carrying over the balance over and over every year. So if you don't want to overfund these, you want to be very conscious because you don't want to have any income left over that you put into this account and then you can use it at the end of the year. There's a maximum carryover amount of $610. So you want to make sure that you put money in there that you know you're going to use for the year so that you don't lose out. And on the right side, you see the dependent flexible spending accounts, which are to take care of things like for a dependent or a child. So you can use up to $5,000 for single or couples that are married filing jointly, or $2,500 for those that are doing married filing separately. So anytime you get an opportunity to save money on a pre-tax basis, I highly recommend that you look at those. And these are all the things that you can do throughout the year so that you can maximize your tax return the year after. So I know it's a lot of information, so I'm excited to see what questions you have. I'm going to come back on.
Yeah. Luis, first of all, that is fantastic. Thank you so much. Quick question. The FSAs, they reset to 0 at the end of the year, right? So every year you start fresh?
They do, yeah. There's a carryover amount that you could carry forward. It's like $610 for this year. So if you didn't spend it all, you can carry that forward and you have a certain amount to spend it. But for the most part, yeah, act as if you're gonna use it or lose it so that you don't overfund it.
Okay. And the other thing is that I know you have many suggestions on how to reduce tax, our tax burden. Do you have any suggestions for people who are already retired? How can they, save on their taxes? How can they reduce their income?
Yeah, great question. That is also another thing that you can still do, even if you are retired, depending on the types of income that you have. So you want to look at the tax bracket. And this is a great opportunity for you to work either with a CPA or a financial advisor, because let's say you had a Roth IRA when you were working and you had a 401k and an IRA and you have a pension. If it's time for you to drain some of those accounts, you want to make sure that you take advantage of the one that's the most tax advantaged. So if you have Roth money, for example, it might make sense for you to take some of the Roth money up front so that you keep your tax bracket lower, right? So these are some of the ways that you can still in retirement plan for which way to best distribute from your account so that you can optimize your tax return. There's some strategies that people implement as well, even in retirement, where they take money that was pre-tax, like in a 401k or a traditional IRA, and they actually do Roth conversions and put them into a Roth IRA because they know that now they pay the taxes on that conversion that year when they're in the lower bracket because they're retired, and then let that money grow for later so that they can take it out tax-free. So there's still a lot of stuff that you can do even within a retirement period.
Perfect. You can guess that some of our audience is on Social Security. So we have a number of questions regarding Social Security. Some say that it's taxable. And can you tell us anything about taxes and Social
Security? I had a feeling.
ARP kind of right.
So yeah, I did. I have a slide on that actually, which I can pull up. So I'm going to give you a very classic tax preparer answer. So it's yes, no, maybe.
That's where the disclaimer comes in.
And it depends. So let me actually, I'm going to show you this real quick.
All right.
Because it's very important. I think the visual would be helpful for people to know if Social Security is taxable or not. So yeah, can you see my screen there?
Yes.
Yeah, so here's what happens. So if your only source of income is Social Security and that's all you have, right? You're very likely you're not going to pay taxes, right? Because that's it. Your taxable income is likely to be 0 and you'll be okay. Now, well, first of all, the good news is in the state of California does not tax your Social Security. So you don't have to worry about that portion of it. But on the federal level, your Social Security could potentially become taxable. So here's how that works. If you look at the chart here, this is directly from ssa.gov. You can go to the Social Security website and it shows you how your benefits could potentially become taxable. So if you have other sources of income, let's say you got a part-time job after you retired, or you have a pension that you're receiving, or you're taking money out of your retirement accounts, like a traditional IRA or 401k, you could potentially trigger taxation on your Social Security. And again, this is another great opportunity that you could do with your financial advisor and say, hey, let's strategize here. I need to take money out of my retirement accounts. I'm also collecting Social Security. How can I maximize my taxes so that I'm not paying more than I need to, right? So here's where the planning comes in. Okay, let's do this much from the Roth. The Roth IRA distributions do not count as income, so therefore they do not trigger any Social Security taxation. So in this case, a person that is filing a single return, if their combined income is between $25,000 and $34,000, you may have to pay taxes on up to half of your Social Security benefits. So not 50% tax rate, just half of your Social Security benefits may become taxable at your tax rate. If you make over $34,000, then up to 85% of your Social Security benefits will be taxed at your tax rate. And the way the formula is, if you look at the bottom, it's just adding your adjusted gross income, any non-taxable interest, and half of your Social Security benefit. That's the formula. So this is a great planning opportunity. If you're a couple married filing jointly, then between $32,000 and $44,000, you might pay taxes on up to 50% of your Social Security. And if you make more than $44,000 of combined income, you may pay taxes on up to 85% of your Social Security. So I've seen people who were very surprised at tax time because they didn't realize it and they took money out of an IRA. It brought all their income from Social Security into that threshold. And all of a sudden, oh my God, I owe taxes because I just didn't realize that my Social Security could potentially be taxed. So that's one of the big myths out there. So that's why I say yes, no, maybe. So it depends on the situation, but no state taxes. California does not tax your Social Security, but on the federal side, you could potentially trigger some Social Security taxation.
All right. We have a number of questions. Luis, prepárate. All right. One of them is about the identity protection PIN, which, thank you so much. I mean, scammers, ARP is all anti-scammers. So thank you so much for the tip. But does the IRA mail the identity protection PIN or email it every year?
Yeah, so I've seen people get an actual letter in the mail.
Okay.
And you do get a login to the identity protection portal where if somehow you don't have your PIN, misplaced it, and so you can still log in and retrieve it as well.
Okay, perfect. Another question. This is specific to somebody. It says, I retired last year and received a regular salary, Social Security, and received an IRA distribution. So I had to make quarterly payments. Why do I have to make quarterly payments when I'm no longer employed?
Yeah, great question. So the IRS doesn't really look at you as far as whether you're employed or not. What they're looking at is what was your income, right? So even if you're retired, you may still be in a high tax bracket. In this case, W-2 wages, Social Security, and an IRA distribution. If you did not withhold enough taxes from either of those, you might potentially, when you file your tax return, be subject to some under withholding penalties because the IRS is going to look at your overall income and say, you owe us this much, but you really should have paid this much earlier in the year. So in addition to the money you owe, we're going to hit you with a penalty. So if you already know that you have these types of income and for some reason you didn't withhold or didn't withhold enough from those different types of income that you had, then the best thing to do is then to send estimated payments to the IRS throughout the year so that you're not considered to have been under withheld. So the way that works basically is when you file your tax return, you have to have withheld either 100% of last year's tax bill or 90% of what you owe this year. And if you made over $150,000, that actually goes up to 110%. So you just basically want to make sure that you don't under withhold so that you're not paying IRS penalties for no reason. So if you didn't withhold properly, yeah, the best thing to do then is just to send estimated payments.
And possibly, for those, that specific strategy, go to a planner, get some professional help, financial help.
Absolutely, yeah, because that's why I said like the best time to see a CPA is not tax season. You can say, look, here's what happened. I retired, or even before that, if you already know, look, I'm about to retire, and here's what I expect for my W-2, Social Security, IRAs. How does my projected tax return? They can do that and say, here's more or less how much you owe. So let's go ahead and withhold this amount from your IRA so that you don't owe, or let's send this estimated payment by this date to make sure that you're still paying timely. Yeah, so these are a great planning opportunity.
All right, another FSA question. Can you claim the cost of insurance premiums?
Great question. So no, this would be, the cost of insurance premiums are typically already pre-taxed anyway if you are employed, right? So you're not paying taxes on those, so you can't double dip those, but this could apply to your co-pays, prescription medication and things like that. So sometimes you have to, they give you like a debit card from the FSA and you just go, let's say, to the pharmacy and just pay with that particular debit card. At some point, they might ask you for some receipt or something to kind of make sure that you're using it for the proper purposes.
Yeah. And Luis, I know that when we started the questions, I think like 36% of the people had not filed their taxes. In California, some people got an extension. Can Can you explain how that happened? How some people had to file and some people didn't?
Yeah, so California, right? Some of us are affected by the storms because of all the rain that we got in 2022, early 2023. So if you have been impacted by the storm, and sometimes that just means living in an area that was impacted. So it doesn't mean that your roof had to have blown off. So for example, Los Angeles County, if you live there, the IRS already recognizing that as a disaster area, and you automatically qualify for an extension to October 16th. Now, the great thing about that is that not only is the extension an extension to file your tax return, but it's also an extension to pay, which is pretty unique because normally when you file an extension, let's say you don't have all your documents ready by April 15th or April 18th in this year, and you file an extension, that only allows you time to gather your documents and file your return later. But if you owe money, you still are, the clock starts ticking at the tax filing deadline, the original one. And you have to start paying taxes, penalty and interest if you don't pay with the extension. This is unique because if you have been impacted by or you live in a disaster area, you're actually getting the opportunity to delay your tax filing until October 16th, delay your payment if you owe until October 16th. Let's say if you were supposed to send estimated payments, you can delay those as well until October 16th. And if you have not contributed to an IRA, a Roth IRA or traditional, that also got extended until October 16th. So a pretty unique opportunity for people those of you that have not filed, if you happen to live in a county that is impacted, well, you can still have some planning to do as a result.
All right. And Luis, here's a question that I have. And my question is about cash gifts to children. Can people give cash gifts to a child and get a tax credit, tax benefit?
So yes, no, maybe, it depends. So here's the way it works. There's something called a gift tax. And you can give an individual every year, I believe it's $17,000 this year. And without having to, as the person giving the money, without having to pay any gift tax. So you're not getting a write-off, you're just not paying taxes on it. And the person receiving it does not have to claim it as income. So that's just one way for you to be able to be charitable and help a child out and so on if you wanted to, without any tax consequences. But there's no additional benefit of actually taking a deduction for it. There's just the benefit of not paying taxes on it. So you can keep it up to $17,000 per individual. And that could be a gifting strategy that you can use without paying taxes from your estate, if you want to just start giving inheritance while you're alive, so, but there's no additional deduction for it, just not paying taxes on it.
All right. And you can do it per child, right?
Per child, yeah. And if you're husband and wife, let's say each of you can give, so you can double that to 34,000 or so. So you can pretty much combine it separately. If you're giving to your kids and they're married and have a child, you can do it per individual and raise up the amount basically without any tax consequences to either of you.
Oh, excellent. And what's the maximum age of a child?
For the purposes of gifting?
Yes.
No, there's no age limit, as long as it's just per individual with no age, doesn't matter.
All right, perfect. And, I know that in your bio, Luis, you talked about financial literacy and trying to help the community because there were some challenges, especially with Latinos. Can you tell us a little bit more about that? Like what can we do to try to help people be a little bit more, financially literate and knowledgeable?
Yeah, I think there are some special challenges or unique to some degree in the Latino population, especially if you're a first generation, for example, like myself, we came here from the Dominican Republic. I came in the early 90s. And one of the things that I see myself, my siblings, and some of my peers dealing with is, and it's not necessarily unique to Latinos, but it's very prominent, where you're kind of sandwiched in between and you're trying to pay your bills, save for your own retirement, et cetera, and take care of your own family, your immediate family, like the kids and so on. But at the same time, you also have parents that are getting older. You may have family back home that you still send money to on a consistent basis. And you're kind of sandwiched in the middle, trying to juggle it both, right? So that adds that additional pressures. And then when you add the fact that Latinos are already behind in home ownership rates, in 401k balances and net worth. It really adds a compounding effect in a negative way. So that's why it's so important to get started as soon as possible.
Perfect. We have a question here and it says, I have a union pension without paid health care at 63, but have not claimed Social Security yet. Is it better to use to claim it at 65 and 8 months? If so, what is the benefit?
So there's a union pension.
Yes.
Okay, so if you claim Social Security before your full retirement age, there's going to be a penalty. In essence, if let's say, for example, at 62, you're going to get 70% what you're entitled to. If you wait until age 70, you're going to get more. If you take it before your full retirement age, you're going to get a reduced amount. So if you're able to wait, that'll be the ideal time to take it, just so that you get the full amount that you need. If you are going to work, for example, a part-time or something, and it's before the full retirement age, there's also going to be a penalty too. So in a perfect world, you would want to wait until your full retirement age, just so that you get your full benefit and you don't have to worry about whether you decided to work after that and so on. So something to consider. And then again, if you're getting that pension, just look at potentially the taxation on the Social Security benefits as a result. So you want to make sure you withhold enough taxes throughout the year to make sure that you're not owing at the end and do any penalties.
All right, perfect. We have a question regarding the filing extension. Do you need to request it or is it automatic if you live in a disaster area?
Great. Yeah, it's automatic. The IRS in the state of California will automatically recognize, based on where you live, that you fall under that zone and you do not need to take any action. However, because of the way the IRS system works, it is still possible that you can still get a letter saying that you did not file your return on time, and they might be saying like, hey, you're going to owe penalties and interest. So they've already pre-warned people and say, hey, we're trying to do our best to recognize that you're already in a disaster area. However, you might still get a letter, but you can just simply call the number on the letter, and just tell them to abate the fees because you are in fact in a zone, and they'll just take care of it.
All right, perfect. We have a question. If you have unearned income such as dividends, interest, rental income, they're asking what's the best investment vehicle since you can't contribute to a Roth or regular IRA? Oh, this might be a little too specific.
Yeah, that one's pretty specific, but I can
Yeah.
say in general,
Yeah.
if you are, in order to contribute to an IRA or Roth IRA, you have to have earned income. So yes, the question basically says, if I have unearned income, then what should I do? Because I cannot contribute to any vehicle that, like an IRA, right? So then one of the things that you would have left, for example, that you can look at is just a brokerage account. It's not going to be as tax efficient necessarily, but you may not have that many options in terms of what's more tax optimized. So you might just be able to open a brokerage account and invest that way instead.
All right, perfect. You know what? I want us to take a quick break and do another poll, because I know you've shared a lot. And the great thing is that this is being recorded, so people will be able to watch it later. I don't know if people are doing screen grabs or, taking, notes, but you'd be able to watch this. But I want to know through the poll if you learned something today. I'm aware of at least one thing I can do to better prepare my financial future. So please let us know. Just answer if you are aware of at least one thing you can do to prepare your. So hopefully people learn something new.
If not, I'm fired.
I know. Luis, buena. All right, let's see if someone please from ARP would share. That'd be wonderful. I want to see what the results are. I usually am able to share. Oh, there we go. Oh, hey, 88% said yes, 12. But we had some pros today by the questions that we were being asked with some really sharp people. So
Yes, so I'm glad to see that. I mean, I take that as a win because that means that that 12% is really highly educated, and hopefully they're already doing all the right things, right? So
yes, absolutely, absolutely. And I know that many people heard, many financial strategies and tax tips to help us prepare for the, for the future and our financial security. But I also want to remind people that ARP has many online resources available by visiting aarp.org. Once again, aarp.org. So, there's lots of opportunities there to get additional information. Here's an additional question. Is my military pension being taxed federally and state?
is your military pension being taxed federally and state? That I
Yeah.
don't know, but I know for a fact that the pension would be taxed at the federal level. I don't know if California has anything specific for military, but on the federal side for sure.
All right, perfect. Let me see, here's the other, and you did answer, a number of these questions, especially the impact of taxes on Medicare premiums. Do you have any advice on that?
Yes, that's another great question. So when you apply for Medicare, they look at the tax return from the prior 2 years. So right now for 2023, they're going to look at your 2021 tax return. And depending on where your income falls, it's going to basically designate the rate. I actually have a slide for that one too. I think it would be pretty helpful. If you don't mind, I can share it real quick.
Yeah, please. Go ahead.
All right, let me share my screen.
You knew your audience, right?
Yes, I knew Social Security Medicare had to be there. So there's something called IRMA. And I always say, oh, she's a nice lady. So it basically stands for income related monthly adjustment amount. So when you look at the chart here, if you make, let's say the first column is for individuals that file a single return. The second column is for people who are married and file a joint tax return. So an individual that makes less than $97,000, this is their modified adjusted gross income. Their premium is actually went down this year. It's going to be $164.90. This is a Part B coverage. For a couple, they can have up to $194,000 of modified adjusted gross income. So what happens is, let's say you took money out of your retirement account, or you did a Roth IRA conversion, pension, Social Security, and so on. You could potentially make yourself go into the next bracket and unintentionally give yourself a bump in your Medicare premium. So this is another reason why you want to look at your taxes ahead of time so that you can plan ahead. And if you need to take money out, you might be able to spread it out during a few tax years or something like that, so that you can plan and make sure that you don't bump yourself unintentionally into the next bracket and end up paying a higher amount for Medicare premiums than you would have had you not done that action, because it could have long-term consequences. So think about the actions of the past 2 years, 2 years ago, are going to haunt you for today, right? If you're close to that age where you're going to apply for Medicare, or if you're already receiving Medicare and you somehow end up exceeding these brackets, and you can trigger for the future, right, that additional premium.
Perfect. Thank you. Luis, and I know I'm bombarding you with questions, so listo. I have a question. I'm interested in purchasing an electric vehicle. Are there any tax credits? And if so, how do they work?
Yes, the Inflation Reduction Act includes tax credits for electronic vehicles. On the federal side, it could be all the way up to $7,500. There are income limits, and it depends on the vehicle. One of the resources I'll share is there's a website where you can go and it actually tell you, you can enter the year, make, and model of the vehicle and find out exactly what type of credit that qualifies for. But you also want to speak to your CPA on this, or your tax advisor, because it depends on your income. There's other criteria. It's not just the car itself, but there is an opportunity for qualifying for an EV tax credit all the way up to $7,500 on the federal side. And then California has additional incentives because they want to, I believe it's 2035, the year 2035, where they want to get rid of all non-electronic vehicles in production, right? So there's an additional incentive on the state side. So I also have a website for that where you can log in and enter that information specifically to you and figure out based on the car you're buying and all that, what you qualify for.
Perfect. Oh, and I see ARP is sharing some links on
Oh,
the
excellent.
chat.
Thank
Yeah.
you.
And speaking of resources, Luis, you shared a wealth of information. Is there any additional resources or that you can share with people? I mean, I mentioned that, of course, ARP has resources and information, and they can go to arp.org/money. So, along with the arp.org, very specific /
Yeah, ARP is
money.
amazing.
Yes, you can find anything there. But any other, Priscilla just shared the IRS protection pin.
Yeah, the protection pin, like Priscilla, she's on it.
She's on it. Perfect. I know people, that was wonderful. Thank you for sharing that information.
Yeah, thank you, Priscilla. Yeah, those are the ones: IRS protection pin, the fueleconomy.gov, cleanvehiclerebate.org. I think Priscilla's already putting all those in there. Those are the main ones to make sure that take advantage of any fuel credits that you qualify for. Get your PIN so that you protect yourself. And then also SSA.gov, just the Social Security website. For those on the younger side, like if you haven't created an account, you can actually go create a free account and download a copy of your projected Social Security statement so you can know what your Social Security is projected to be when you do retire, and also see the difference between what it would be like if you take it at 62 versus full retirement age, or if you wait to 70, because it can help you plan as well, determine how long you want to work for. And so, so that's another great resource.
All right. And Luis, last question. When hiring a CFP, is it better to pay hourly or to simply pay the person to help you select your investments, or pay the 1% fee for their advice?
Yeah, that's a great question. So it depends on where you are. I've met people who, let's say, those in the 12% that answered, hey, I didn't really learn anything new, right? If you're already very savvy, you pretty much know what you're doing, you feel confident in your plan, and you may only need a professional to kind of bounce certain ideas off of, maybe something that you're considering a project. And so I would say hire a professional that's a CFP certificate that works on an hourly basis or project based. So you can just work on something very specific, right? However, if you are a person that wants to be very hands-off in certain things, like your investments, for example, and you have a significant amount of money you've accumulated throughout your years, but you're also looking for somebody to help you in addition to invest your portfolio, but also plan for your retirement, tax optimization strategies, and also give you support within the year, then you can do either a flat fee or a percentage of assets under management. The different CFPs charge differently, but when you're interviewing one, based on what you need, just ask how they charge and what is included in that fee. And not one answer is necessarily better than the other. Sometimes the model where you pay a percentage of investment is fine if you're getting all the support you need in addition to investment management. And if you feel like in a really good spot, then you might just be better off with somebody that's either hourly or project-based. So it depends on your situation.
All right, perfect. Luis, you have been a wealth of information, pardon the pun, but is there anything else you want to share before we, end our session?
Yeah, I would say just take advantage of time. We all have heard of compounding interest, how when you invest, right, it just goes to your advantage. So the sooner you start, the better. Even if you feel like you're not where you want to be, don't let that deter you from taking some action. So, there's no better, the best time to plant the tree was 100 years ago, but the second best time is today, right? So just get started, even if you don't think that you don't have to have millions to start investing, right? You can start an account with a very small amount and just build that habit until you're in a better position.
Thank you so much. And also thanks to everybody who joined our Let's Talk Dinero chat, where we feature experts like Luis from across the state talking about debt management, investing, retirement planning, entrepreneurship, taxes, and lots more. And speaking of, mark your calendars for Monday, May 22nd for our next Let's Talk Dinero event. Once again, Monday, May 22nd, we're going to have a Let's Talk Dinero event. And ARP is here for you with resources and events to help you choose how you live as you age. Visit us online at arp.org/ Let's Talk Dinero, and you can view the previous recordings and the list of upcoming events. Once again, arp.org/Let's Talk Dinero. And you can view the recordings like this one. This one will be up maybe in a week or so, so keep checking. And I know that there was so much information that, came our way, so it's great to revisit by viewing the recording. And lots of others. We've had some wonderful on how to buy a house and so many other things. Luis, mil gracias for joining us. You've been wonderful. Thank you for sharing your expertise with us. We have come to the end of our session. Thank you, everybody. Have a great evening, and we'll see you next time. Hasta luego.
Gracias.